What is an exit strategy? It's simply a plan for exiting a stock trade. And it outlines when to sell and how much profit or loss that you're willing to accept. When you have an exit strategy in place, it can help you manage your risks. It can help you maximize your profits. And really, a good exit strategy is tailored specifically for each trader. Everyone has different goals, different objectives when they're trading. For some, a trader may want to hold on to their stocks until they reach a certain profit target. And others may like taking profits as price continues to move in the direction. So you got to know your personal preferences before you can decide on a strategy. Another key component is setting your stop loss orders, and they just allow you to automatically close out of your positions if price reaches a certain price level, and that should help you avoid large losses on trades when they don't go according to your plan. And this is actually especially useful during volatile markets because price can move quickly in either direction without warning. And also keeping track of all your trades with detailed notes on your entry points, your exit points, and reasons why you choose to exit. That's going to help ensure consistency in your future trades. So you got to review these notes. So why is it important to have an exit strategy? Well, it helps to make decisions about when to get out of a trade. And that's all based on your risk tolerance, your goals, and your strategy. And without an exit plan, you may be tempted to hold on to trades for too long or take profits too early when you're in a winning position. When you have an exit strategy already in place, it can help you stay disciplined, help you stick to your trading plan. It also, more importantly, helps avoid emotional decision making because that always leads to costly mistakes. For example, if the market moves against your position, having an exit strategy for losing trades are going to prevent that whole hope and pray that it's going to come back method of trading. If price hits your exit, you're out. It's that simple. And you got to know your time horizon. Day traders probably going to have more frequent exits than swing traders. Swing traders, they actually tend to hold trades longer than a day, but they're also going to have exit strategies to manage their trades. So here's 4 strategies to use. Number 1, having a stop loss order, right? You just set your order to exit at a specific price level. You do this to limit your losses that will happen if price moves against you. So for example, let's say you bought a stock for $50 and you set your stop loss order at 45. When that stock drops to 45, you get closed out of your position. And in a perfect world without slippage, you don't lose more than $5 a share. Trailing stops, these are a great exit strategy. It allows you to lock in profits as price is moving higher or lower. And this works by setting an initial stop loss below or above the current market price, but you don't set profit targets. And if price reaches that target price for your stop, you're out. So as price moves up or price moves down, so does your stop loss. So it allows you to capture gains, helps you limit your losses. And you can use, X bars back, or you can even use the chandelier exit indicator. Time-based exits, these are simply, you set an expiration date on your trade. You don't rely on a technical indicator or anything else. And when you use this kind of approach, it's almost impossible to get stuck in a position due to fear or greed. And from experience, traders start to take profits 3 to 5 days into a trade. And that's the usual time that passes before price starts to go against you. Volatility-based exits, these are good because they react to the changes in volatility in the market. So generally, high volatility indicates higher risk. So you may want to close out your positions during these periods or even just tighten up your stop. On the flip side of that, low volatility, that's often associated with calmer markets. You're less likely to experience big moves in either direction. But regardless of the market, you got to have an exit strategy in place. You have to have that. And when you understand different exit strategies, it can help you make decisions on when to take profits or cut your losses. And it's all based on a plan. So let's talk about indicators and which one's the best to use. So let's talk about moving averages. They're a popular choice. They provide an easy way to not only identify trends, but also short-term momentum shifts. So if I'm using a 10-period simple moving average, you can ride the momentum and it allows the gains to add up. But once price closes above or below the average, you'd get out of the trade. Support resistance levels, they can be used as indicators of when to exit a position as well. If price breaks through these levels in the opposite direction of your trade, it could signal that the trend is over. It's reversing. It's time to close out. Bollinger Bands, another popular tool. And these bands are just 2 lines plotted 2 standard deviations away from a simple moving average. So when price moves outside these boundaries or the band's balloon, it could indicate that price is overextended and it's going to look to move against the main direction. Keltner channels, this is where you're going to look for moves outside the bands. These also gives you an indication of increased volatility. These bands here are set 2 ATR away from a 20-period exponential moving average. Reversal candlesticks through the higher low of the band, it's a sign to take profits or tighten your stops. If price is above the bands, it may have you tightening the stop closer to the current price. You have the MACD, the moving average convergence divergence. So when the MACD crosses 0, this indicates bearishness, while crossing above is bullish. And that could potentially signal times when you should consider closing out your positions accordingly. And for a quicker exit, just look for a crossing of the fast line and the slow line. When's the best time to exit? Well, if you have a goal of making 10% profit on your trade, for example, you could exit when that goal is reached. On the other hand, a trader may have a low risk tolerance. They want to minimize losses as much as possible. So they may choose to exit at any point where prices begin falling against their buy position significantly. Some traders are going to use multiples of risk reward. This means a trader will look to close a trade at 1, 2, 3, or 4 times whatever they risk. Market conditions. Another important role. If market conditions are favorable for your stock trade or your options trade, whatever you're trading, at the time of the entry, and then you might consider taking profits when markets tend to become choppy. Timing is also a key factor when it comes to deciding the best time for traders to exit from the trade. So some may choose to enter into trades just prior to or during the earnings releases. That way they can capitalize on potential price swings due to the announcements. But once this period ends, they should have an exit strategy to get out. So what's the best indicator? Well, it's just the one that you're going to use in a consistent manner. There's no right answer. You could use a moving average, the RSI, stochastics. They can help identify entry and exit points in the market, keep you objective. Using risk and reward ratios, trailing stops, or exiting after a certain amount of days, all viable approaches to getting out your trades. So knowing when to get out, that can actually be the difference between success and failure in the markets. And there are several strategies you can use. We talked about those: trailing stops, time-based exits, target prices. Consider using an indicator. Timing is key. Understanding when to make your move to get out or even into a trade. It's going to help you maximize your profits. And we also have a free guide here. It's called The Ultimate Guide to Price Pattern Trading. It's totally free. You can find ideal entry points with low risk. Again, it's a free guide. The link is below in the description or off here to the left. Thanks for watching.